Welcome back, everyone, to this week's Kingcrowd Investment Roundtable. As always, we're going to be covering some of the different data and trends and insights that investors and founders and others in the online investment markets are interested in. We're also going to be talking about some key terms related to some different investment offerings, such as Elemeno Health today. And we're going to be diving into the data around investing in transportation startups. What startups and what categories of transportation are getting the most investor dollars? I'm joined, as always, by our two amazing investment analysts here at Kingcrowd, Leah and Teddy. How are you both doing today?
Doing well. Good to be
Doing
here.
Great.
Awesome. Let's dive right into it. Leah, you put together the chart this week that took a look at the dollars being invested in transportation startups. I'll pull it up here on the screen. Would you mind just sharing a little bit in terms of what you saw and what we were looking at for that?
Yes, the transportation industry has been booming recently on equity crowdfunding platforms. So we wondered, when we talk about transportation, in most cases, we're talking about vehicles. So in which vehicles are investors actually investing? The top vehicle in which investors invest is not a surprise. We're talking about cars right here. A couple of companies such as Alpha Motor, Liquid Piston, and Aptera Motors really raised millions of dollars recently. So when we talk about companies like Alpha Motor, for example, we're talking about electric vehicle, and we see that there is a boom in the electric vehicle market where a couple companies are trying to emerge. Next, we have planes, which is kind of surprising because when we think about planes, we think about the two kind of major plane manufacturers of Boeing and Airbus, but there's actually a whole industry that is using plane trying to improve them. So for example, we have companies like Starfighter Space that uses plane for satellite launch, and that has been raising a lot of money recently. Last but not least, we have the eVTOLs. So eVTOLs are kind of a thing of the future because these are basically flying cars. The problem with eVTOLs is that they evolve in very highly regulated environments, and no one is really used to using eVTOLs right now. These are basically electric helicopters. So, Teddy, Brian, can you tell us what is your look on eVTOL as an investor? Do you think this has potential?
It's tough because, right, like a lot of these are operating in really regulated spaces. So not only do they need quite a lot of money to bring a product to commercialization and, getting the manufacturing under control, costs under control. So that requires a lot of capital to get off the ground. But then there's also the regulatory piece of it, especially for like flying cars, for example. Like that's going to take probably a decade to really like actually be a suitable form of transportation to like fly above cities to avoid traffic. So I think they're what we call moonshots at Kingcrowd. They're like things that have a very low likelihood of really scaling up anytime soon, like in the next 10 years. But if one of them does, the return is going to be massive. So that's why you'll tend to see a lot of these companies, the futuristic type companies, have very high valuations. It's to not only represent that, capital intensive companies generally have higher valuations. That's just the nature of bringing in a bunch of money and the post money valuations and all of that. So it's tough. I am not invested in any of them at the moment. I don't think KC Capital is either. I think it just requires so much execution. So we really need to have such an amazing team in place and access to tons of capital. And I think that is something we just haven't seen yet for the eVTOLs and the futuristic stuff. Obviously, like car companies, like electric cars or liquid piston, making a different kind of combustion engine. That is a bit more doable and it has a little bit different of a profile. But Brian, curious what you think.
Yeah, I find, the whole VTOL, just, vertical takeoff and landing is really fascinating because it would be kind of a complete game changer in the way that people potentially would commute or get around, right? Everything today, all the infrastructure is based on roads, and there's a lot even just with self-driving cars and everything where that could look very different in 5 or 10 plus years. But this would be even kind of another step function change. And when you're trying to think about technologies that would really change the world, as Teddy mentioned, it takes a lot to get there. Aerospace, I had an aerospace engineering background. Now, I did not specialize on eVTOLs, but especially when you're talking about electric, that means having a battery. And one of the things about batteries is that they are very heavy. And when you have something very heavy, that's competing almost exactly opposite with what you want for something that's going to be flying and, taking off and landing. So the technical challenges are definitely, there's still a lot to happen there. I'm sure there's going to be improvements in battery technology and even potentially with, some of the aerodynamics of how these things work, but it means that a lot of capital is required. So probably a lot of these businesses, going to be pre-revenue for a long time, going to be investing heavily in capital. And so it's a very risky, but potentially high payoff reward. So the question I think investors need to just think of is, with where technology is at today, is that something that's going to happen in the next 5 years, or is that more 20 to 30 plus years out? And that's something that no one really knows. You can't predict the future from today, but it's just that type of business. You need to think with that mindset, in my opinion. So.
Yeah. And I think it can apply even to, not moonshot industries. Like, you have to, as an investor, you have to think of, is this disruption that this company is looking to make, like, is it too early? And with like deep tech, futuristic tech like this, it like often is yes, but I mean, that's the bet you're making is, the company will figure out a way to get it to commercialization and be part of this shift in, like in this case, like society and how people move around. Like, it's quite big. And I'll lastly just say, like, this is kind of the extreme, but like Elon Musk, SpaceX, like reusable rockets was like not, and Brian, I'm sure you know this, like that was like not a thing. And that was like his big disruption. And it took him so long to lobby because NASA basically had like two manufacturers it was working with exclusively. It was like pretty much a duopoly. And it took him so much money and so much time to like get in. And now he's the biggest contractor of NASA for rockets. But it took him so long and so much money and on the brink of bankruptcy multiple times. Again, this is rockets. Mm-hmm. So the capital intensity is like a different level than what we're talking about here. But just something to keep in mind. It's in the difficulty of bringing a company like this to scale. It's near impossible, which is why it's a moonshot.
Definitely moonshots are extremely risky. When they work, if you think about SpaceX or Tesla, they can bring huge returns to early investors. But we have a company called Lucid Motors. It's an electric vehicle company as well. It has faced so many issues recently. Some of the cars has to be called back due to a fault in the system by the Traffic Safety Administration. And so investing in EVs, eVTOLs, or other moonshot companies also expose investors to some of this technological risk that can make a company have to file for bankruptcy. So this chart overall is showing us the 6 top vehicles in which investors have been backing recently. There actually were about 15 total different types of vehicles, so we're only showing you the 6 top. One that is very interesting to see right now is also the bicycle industry, which in 2020, 2021, we kind of have the boom of the e-bikes. We had a lot of money invested into e-bikes. And right now, as you can see, this is down to 2.2 millions. So we have to be careful as investors to understand, why do we invest into a company? What is the competitive space? And not invest just because the industry is booming. If you look at e-bikes, I'm sure that a lot of the companies that raised a lot of money in the last couple of years may not be doing as well now as the e-bike trend is kind of going down.
Yeah, I remember that was all the rage for a while. It was the micro-mobility with Lime and Bird and all the different scooters and bikes and everything like that. But as they get into markets and I think start scaling, there's issues that comes with that. And so I think a lot of those companies have been working through some of those complications now. I know there was at least one or two actually. There's been a couple, micro-mobility, like scooter ones as well, that have raised on equity crowdfunding in the past. And at least one of those I know has shut down. So it's a tough market, right? It's competitive, but it's sort of, things are going to change. It happens. It's incremental over time. And so to be able to get innovation you need to support these things. If it was obvious, everyone would be doing it. So sometimes it's another thing to keep in mind that I actually look through the lens when I'm looking at an investment is there something non-consensus about this investment? Because if it's like, oh, this is obviously the future, everyone's going to be doing this, it's either going to be priced extraordinarily high where most of the rewards are going to be out of it. So take SpaceX today, right? Like everyone knows that SpaceX is just crushing it, but you're going to pay hundreds of billions of dollars, whatever the latest valuation is. Versus in the early days, it was very uncertain, highly improbable, I think in a lot of people's minds. So because of that, the risk reward from an investor perspective would be you'd get more potential reward for investing. So just something to keep in mind when people are looking at these investments. Let's move on to the next topic. So one of the current investments that we are taking a look at and that the investment team is taking a look at and talking about is Elemeno Health. Teddy, I'll toss it over to you. Tell us a little bit about what the opportunity is here and what's so interesting about the company.
Yeah, so Elemeno Health, we've seen them before in the equity crowdfunding space. I think they raised a few years ago, but their main product is they offer custom-built training platforms for hospitals and clinics to aid the healthcare workforce in getting what they call just-in-time information. So that's when these practitioners are on the job and they need access to some random procedure manual or like a manual for a piece of equipment and the exact best practices for certain equipment. And a lot of times practitioners need this like very quickly. And the current kind of status quo in hospitals is there's a lot of like actual like papers, binders, and procedure guides are kind of all over the place. Some of it's online, but there's no kind of real streamlined way to get this information like in real time in the actual field. So what Elemeno Health does is they work hand in hand with these hospital systems to build out a sort of content library for the practitioners to use whenever they need to, and have some AI assistance in terms of labeling of the information and sort of the generative AI piece that's trained on the content library to really get information as quickly as possible. So they're super interesting because you'll notice that they're raising at quite a big valuation decrease, so a down round. And they have a lot of venture capital backing, participating in this new round. So it's certain that the venture capitalists set the price of this new down round. And in looking at the raise page, the Q&A page, it seems to be the reason for this is they went through a sort of a pivot kind of right after COVID hit, which at first they were focused on mainly just like orientation training and building a kind of white label, or not white label, more of like a white glove type of solution where they really work with the hospitals to build out kind of onboarding and those types of things for new employees. But they kind of pivoted more towards workforce training and kind of continually providing new training to practitioners and getting this information in a consumable, like bite-sized way in real time, which is kind of the big value prop here. And because of this kind of pivot, the gross margins of the business like fell pretty drastically, and they brought in a new CEO to help kind of bring this back up. And now they're back up to about 60% gross margins. So they really sort of turned around the margin profile. In the meantime, still growing revenue year over year. So I actually think in terms of down rounds, it's one of the more promising ones we've seen because they've clearly stabilized the business and have their venture capital investors still kind of adding on to their position and supporting them. So a lot of times down rounds are seen as quite negatives, which generally like there is some negativity around it and something happened for that to be the case for a down round to occur. But in the case of Elemeno Health, it seems like they've really stabilized, and I think it's actually quite an attractive price now to get into at like 3x revenue at this point. So interesting one, but curious your thoughts.
So the one thing that I think we want to highlight as well, so full disclosure, I had actually invested in Elemeno Health, a very small investment back in their first round in 2020. So I was at a $12 million pre-money valuation or safe, I believe. Yes, 12 million valuation safe. So my investment is already down from this potentially, right? But I think that's one of the reasons down rounds can sometimes be painful because it's kind of a mark to market for current investors. And it's like, ooh, I feel like I've taken a hit in terms of my original investment where it's now cheaper. Plus the new money coming in is potentially going to dilute those investors who were already invested previously. Now, $5 million early bird valuation, as Teddy mentioned, for a company that has 1.7 million in fiscal year 23 revenues, pretty attractive, even at 6 million pre-money valuation. However, another big factor you need to consider here is the prior total amount of capital raised and whether that prior capital was common or preferred shares, because preferred shares can come with liquidation preferences. So, Leia, do you want to tell us a little bit about common and preferred equity and why that can be an important consideration in addition to just the valuation?
Yes, when you invest into common shares, you're receiving a stock in the company like if you were investing in the public market. You technically are supposed to have voting rights, but we've seen a lot of cases on equity crowdfunding where your voting rights are automatically given to the CEO. Now, when you invest into preferred shares are usually more favorable to investors because they bring what we call liquidation preference. That means that in the case of the sale of the company, whether it's a liquidation or an acquisition, what will happen is that the cash is going to first be distributed to debt holders. So the bank, all the notes are going to be reimbursed first. And second, the preferred shareholders are going to be paid based on their liquidation preference. So if you have a 1x liquidation preference in your investment, you basically are going to be given the equivalent of the amount of money you invested into the company first before anybody else gets the investment. As soon as all of the preferred shareholders get the investment back, then we can start sharing the returns proportionally to every single investors, including the common stockholders. So usually it is better for investors on equity crowdfunding to invest in preferred shares than in common stock. In the case of Elemeno Health, what we see is that even if the valuation is $6 million, investors that are investing in this current round would have to wait at a future point at a higher valuation to actually see the investment. And Brian, do you want to tell us what is going on in this specific case?
Yeah, so I just looked it up. We capture this on every raise that we do. And so it looks like Elemeno Health has raised about $21.7 million in prior rounds. Now, that's probably going to be a mix of safes, convertible debt, common, preferred. So we can't assume it's all preferred shares. But for the sake of being conservative and for this example, let's just assume that all 21 million that they raised prior to this current round was preferred shares with a 1x liquidation preference. What would mean is that even if you as an investor invest in this current round at a $6 million valuation, and let's ignore it, this round is also preferred shares, but for the sake of showing common versus preferred, just to illustrate the example, assume it was common and that you invested at a 6 million valuation. If the company sold for a $12 million valuation, common shareholders are going to get zero because in this simple example, and this is not the exact case for Elemeno Health, but there was that 21 million of 1x liquidation preference already in there. That's referred to as kind of a liquidation overhang. And they would all need to get 100% of their capital back before common shareholders get anything. So that's why it can be very important to dig into the cap table, understand how much preferred equity was issued in the past and what the liquidation preferences were. Now, as the company gets bigger, it can be less bad for investors because, for example, with this example, you may not get anything until the 21 million of what they raised if it was all preferred. But after that, you are getting more pro rata based on your equity holdings. And so you might actually then start to get 1x your capital, 2x much quicker, not at multiples of the 21 million. So getting a little complex here because of, trying to talk through the math, but it's just something very good to keep in mind. And we can probably do deeper dives into this in the future. But Teddy, anything else you want to say about Elemeno Health or anything related?
Yeah, so the last thing I'll say is we could probably do an entire video on preferred shares, liquidation preferences, and there's something called participating preferred and non-participating preferred. So what Leia described where preferred shareholders would get their liquidation preference and then participate pro rata, after the common shareholders are distributed, that's called participating. It's like double dip where you get your liquidation preference back and also participate pro rata in the upside. Generally, preferred shares are non-participating preferred. So the preferred shareholder has to decide whether they want their liquidation preference, which is generally just their money back, or converting into common and just participating pro rata in the upside. Generally, like if it's a big hit, then they'll just convert into common and just participate pro rata in the upside. But generally speaking, yeah, preferred shares provide some downside protection for investors. And if you're buying common shares, that affects the payout for you because they have to get paid back first. But even if you're purchasing preferred shares in the new round, you definitely want to like take a look at what the order of liquidation is, because there's the liquidation preference stack. So earlier rounds may be getting paid before you do. And sometimes it's reversed where the newest money in gets paid first, but just some, obviously pretty technical, but some mechanics to look into.
And this is where every deal is going to be different. That's why it's so important where investors really need to understand those different terms and reading the subscription agreement before you invest. Because again, if this was just common stock at a 6 million and there was no previous preferred shares, cool, that's very straightforward. But because there's been all this prior investment and some of that has been preferred, you need to take a look at all of this to actually decide, is it right for your portfolio? Is it a good investment for the terms being offered?
Yeah, and if you're buying common shares and there has not been any preferred equity given to prior investors, that's not to say they won't raise preferred equity stock in the future, and then they will get in front of you on the liquidation preference stack and all of that. So, yeah, again, just there's nuances to investing for sure, and I think it's worth the time to really get up to speed with all of it because it can really affect your returns. So.
Great. Well, I think we've covered a lot for this week, given a lot for investors to think about. Let's wrap things up there. Thank you, Teddy. Thank you, Leia, for another great discussion. As a reminder, everyone who's watching this video, if you want to get more data-driven insights weekly delivered to your inbox, sign up at pitchreviews.com. Also, feel free to head over to Kingcrowd, check out those deal pages. We provide a lot of this analysis that we've discussed today, both in the charts and also on the raises. We'll see everyone back for the next one. Thank you.